In the last few videos, we talked about two important ideas. First is that markets are not normal. Big moves happen more than we expect. And the second is exactly why I don't rely on discretion. I prefer rules because rules remove emotion. But here's the next logical question. If we're going to rely on rules, how do I know these rules actually work? And that's where backtesting comes in. And that's what today's video is about. Imagine I create a strategy that returns 24% on average for the last 25 years, say. It avoided most crashes, it had a beautiful uprising equity curve. Would you invest in it? Most people would say yes. But here's the real question. How did I build it? Because that's where things get interesting. So let's strip this back. A backtest is simple. You take a set of rules, for example, say 5 of the strongest stocks within the US market. You rebalance every month, you stay in cash if the market is below its 200-day moving average, and then you apply those rules to historic data. You're basically asking, if I followed these exact rules since say 2000, what would have happened? And that's a backtest. It's not prediction, it's not magic, it's just applying rules to past data. And if you're building systematic strategies, you have to do this, otherwise you're guessing. So backtesting isn't the problem is what happens next. So let's say I test a strategy and the results are okay. It's not amazing, but I decide to tweak it. I pick 10 stocks instead of 5. I adjust momentum factors from 12 to 6. Instead of a 200-day moving average, I use a 150, then a 180, then a 220, and I keep adjusting. And every time I run a new test, eventually one looks incredible. Huge returns, small drawdown, a smooth curve. Now here's the uncomfortable truth. Did I actually discover something powerful and a real edge in the market? Or did I just adjust things until I found something that happened to work well in the past? That's the distinction. That distinction is everything. Let me exaggerate to prove the point and to make it obvious. So imagine I say I'm going to buy stocks that went up exactly 17% over the last 83 days, but only if it occurs on the first week of the month. And the volatility has to be below a certain level. That sounds ridiculous. But here's the thing, if I test enough strange combinations like this, eventually one of them will look amazing historically, not because it's real, but because markets contain randomness. So when you search through enough combinations, you'll eventually find something that fits the past perfectly. But that doesn't mean it will work into the future. Financial markets are noisy. Over the past 20 years, there are thousands of random moves, and if you allow yourself to, say, change look-back periods, change the numbers of positions, change filters, change entry rules, change exit logic, adjust position sizes, you're just increasing the number of combinations that you're testing, and the more combinations you test, the higher the probability that one of them will look fantastic purely by chance. So that's how people accidentally fool themselves. It's not intentionally, it's accidentally. And here's where it becomes a real problem. When you see a strategy online with a perfectly looking smooth equity curve, very little drawdown, high annual returns, you don't see how many versions have actually failed, or how many parameters have been tested, or how it's been tweaked behind the scenes. You're only seeing the winner. And if someone tested 200 variations, of course, one of them is going to look incredible. But the question is, will that look incredible going forward when you take it into unseen live data? And that's much less certain. And this is why, when I build strategies, I use a specific workflow to try and keep rules simple, avoid excessive tweaking, use logical reasoning for parameters, and avoid hyper-precise numbers. For example, there's rarely a meaningful difference between using a 197-day moving average compared to a 200-day moving average. If changing parameters slightly improves results, then it's a massive red flag, because robust ideas shouldn't be that fragile. I'm not trying to create the best looking backtest. I'm trying to build something that survives into the future. And those are very different goals. So here's the takeaway. Backtesting is essential, but it's also very easy to misuse. If you keep adjusting rules until the past looks perfect, you may not have found a statistical edge or found any skill. You just found luck. So in the next video, I'm going to explain one specific concept that elaborates on why this can happen and how to avoid it when designing systematic strategies. Because if you're going to invest with rules, you need to know if the rules are real and when you're just beautifully disguising randomness. I'll see you in the next one.